Scalping is a day trading strategy where you take really short-term trades, sometimes holding positions for just a few seconds up to a few minutes, with the intention of taking small profits either once, twice, or even multiple times a day, letting those small wins stack up over time. If you're brand new to trading and you've heard about scalping and you're like, where do I even start? Then let's break it down step by step. First things first, you have to know what you're getting yourself into. Scalping is fast and stressful. You're not holding trades overnight, you're not waiting hours, you're taking small, fast wins and cutting losses quickly. It's basically a numbers game, not a guessing game. And you're not looking for the perfect trade. You're looking for as many high probability setups as you can that give you a slight edge over time. So what is the edge? Let me explain with this simple idea. Let's say you have a scalping strategy that wins 60% of the time. You risk $10 to make $10. That's a 1-to-1 risk-reward ratio. Now, if you do that over 100 trades, odds are you'll win about 60 trades and lose about 40 trades, meaning you'd be up by $200. Not because of one big trade, but because your strategy gave you a statistical edge over many trades. Even if your strategy has a high win rate, you could easily lose 5 trades in a row. That's just variance. It happens, and the problem with new traders is that they expect to win all of the time. And that's just not how trading works. You have to expect to lose quite a lot of the time, and this has to be factored into your strategy. What really matters is that you stick to your plan. You keep your risk controlled, and you don't panic and start gambling. Most people give up when they see just how much they're losing, because even if your strategy is solid, weird losing streaks can and do happen. Just like flipping a coin and getting tails 5 times in a row. It doesn't mean that the coin is broken. Your strength lies in being able to recognize this and not abandon your plan and start revenge trading or doubling your position to make it back. That's how people blow up their accounts. You have to let the probabilities play out and don't judge the results by a single trade. Instead, you want to think like this: how did I perform over the last 20 trades? Did I stick to my strategy and follow the rules? Did I stay emotionally neutral? Trading is not about predicting the future. It's about playing a game where the odds are just slightly in your favor. And playing that game over and over again with discipline equals long-term profits. That's the mindset of a probability-based trader. And that's where consistency comes from. Now that we've got the psychology down, let's look at an actual strategy. This is a winning scalping formula broken down into 5 simple steps. Step 1, get yourself set up with the best possible head start. And by that I mean using a decent broker that has low spreads or commission, fast executions and no restrictions. There are plenty to choose from. Just do your research and work out what works best for you and for your location. I use TD365, which has really tight spreads and no commission. And there's a link in the description box if you'd like to sign up with them. Other brokers that come recommended for scalping are Thinkorswim, Lightspeed, IG, and Interactive Brokers. Again, do a bit of research and always try them out in demo mode until you're really comfortable with the platform. Step 2, once you're up and running with your broker's trading platform, then we're going to open up the stock or futures market that we want to trade. And the first thing we're going to do is we're going to add an indicator called a 200 EMA to the chart to help us see what state the market is currently in. So in your trading platform, you want to find the indicators button. In my case, I'm using TD365, so I'll click on studies, type in moving average, select that, and I'm going to add a 200 period exponential moving average, or EMA. So I'll type in 200 and change this to exponential. So you can see it's added this line to the chart, and this is a really helpful tool for identifying the overall trend of a market, as it smooths out the price levels over a long period of time, giving you a much clearer picture of the market's condition and direction. Just remember this simple rule: if the market is in an uptrend, the price will be trading above the 200 EMA line. If the market's in a downtrend, then the price will be trading below the 200 EMA line. And obviously, we only want to place a long position in an uptrending market, and we only want to place a short position in a downtrending market. Simple enough. And if you'd like a more in-depth look at this, then check out my video dedicated to moving averages up here. Now we have the 200 EMA equipped on our chart and we know where the market is trending, we can move on to step 3, where we're going to add in another indicator This one's called the MACD, and this is going to help us see where a new trend is about to occur, because scalping works best in trending markets. So let's add that to our chart. Search for MACD and select that. I have a whole video on the MACD, so go and watch that after this video for a more in-depth look. But for now, to very briefly explain, you'll see two lines and a histogram. The first line to look at is this white line here, and this is the primary MACD line. The second red line here is called the signal line, and the histogram represents the difference between the MACD and the signal line. And lastly, we have this line running right through the center, which is the baseline or zero line. And all you need to remember with this is that you look for when the white line crosses above the red line, but only when it happens underneath the baseline. This crossover suggests that the price might experience some upward momentum, so we can confirm that the market is in a general longer term uptrend with the 200 EMA, and then we can use the MACD to see where a new trend is taking place. Step 4 is to look at the price action, focusing on candlestick patterns and key levels of support and resistance. So let's identify these key levels first. And these are in areas where the price has previously bounced and reversed, and they can act as good potential entry and exit points. In an uptrend, look to buy near areas of support where price has previously bounced. So we'll use our line tool to draw in our lines of support and resistance. Once we've done that, it's time to look at the candlestick patterns to time an entry. And all I'm interested in is an engulfing candle, which looks like this, where a larger green candle completely covers the previous red candle, which can be a sign of an upward move. So when we see one of these engulfing candles breaking out of a support or resistance zone with strong momentum, which we can see with the MACD crossover, it can signal the start of a new move in that same direction. Step 5 is risk management. Always use a tight stop loss to protect yourself. You typically want to place a stop just beyond the most recent high or low swing level, and never trade any more than 1% of your trading capital. So if you've got an account of $1,000, you only want to be trading with about $10 per trade. You might also want to aim for a risk to reward ratio of 1:1 or 1:2. 1:2 meaning that you would set your stop loss to lose $10, but your take profit to win $20. So set this up in a way to avoid greed, maintain discipline, and save your account from blowing up. You also never want to have the mindset of, I think it's going to go up, I just need one more big win to make my money back. It should do this, it should do that. Trading is not about being right. It's about being consistent with your strategic edge. If the setup shows up, then take the trade. If not, sit on your hands and wait until your strategy starts playing out. Scalping is fast-paced, but it's still a probability game. If you focus on being disciplined over being right, the probabilities will work out for you, not against you. Now, these are the biggest mistakes beginners make when scalping. Overtrading. This is where traders engage in an excessive number of trades, often beyond their strategy or risk tolerance, resulting in big losses and devastating emotional stress. To avoid this, try to stick to a certain number of trades per day. I always used to stick to 1 trade per day usually, so find out what works for you. Chasing the price. This is when traders see the price rocketing up, FOMO sets in, and they buy in to ride the wave. But what tends to happen is they end up buying right at the top of that wave, and then the price immediately falls back down again, resulting in huge losses, especially if no stop loss is used. To avoid this, look for breakouts of support levels, not resistance levels, and never ever buy at the top. Not using a stop loss. Traders who fail to use proper risk management tools like stop loss orders, or who constantly keep moving their stop losses to avoid being stopped out, end up losing far more than what they should be losing, causing the probability of the strategic edge to vastly go against them. Revenge trading. This is getting angry at the market for going against you and then trying to make a quick recovery by taking more aggressive trades. This leads to, more often than not, compounding losses rather than recovering them. Using too many indicators. While indicators can be really helpful tools for making decisions, relying on too many of them can lead to an overload of information, ending up with conflicting signals. It's called paralysis by analysis, when too much information makes traders become overwhelmed and freeze when it's time to make a decision. Trading without a plan. Now, this is just straight up gambling. betting red or black on roulette. The plan or strategy is what gives you a slight edge over the 50-50 probability. And with this slight edge, over time, you will become profitable. So stick to the plan. So let's have a quick recap of everything you need to get going with scalping. Accept that not every trade will win. Sign up to a good broker for scalping. Use a 200 EMA to see the current trend of the market. Use a MACD indicator to see where a new trend is occurring. Draw in key levels of support and resistance. Look at the price action and spot engulfing candles breaking through key levels. Risk 1% or less per trade. Check on your performance over the last 20, 50, 100 trades. What's your win rate like? Stick to the strategy and follow the rules. Stay emotionally neutral. Remember that you do get a lot of false signals from indicators, so always have your risk management in order. You can, of course, use all sorts of different indicators to help with scalping. This is just one simple method for beginners. As you become more experienced, you can experiment with other indicators. Remember to always try out this stuff in demo mode until you're really confident in what you're doing. When I first started out, I traded in demo mode for around 9 months before I went live with a real account. So it's really wise to not jump straight in and practice this as much as you can. So best of luck, thanks for watching, and I'll see you next time right here on MAFFMARKET.